Good evening. My name is Charlie Coker, and I'm the Executive Director of Asia Society Southern California. I'd like to invite you to this evening's program, Money Games, the inside story of how American Dealmakers saved Korea's iconic bank with Weijian Shan. This evening, we're very happy to have not only Dr. Shan joining us, but also Jonathan Karp, who will be moderating the discussion today. Without further ado, I'd like to introduce Jonathan Karp, who will set the few ground rules for asking questions and some various other issues for the evening. Thank you so much.
Hi, good evening, everyone, and welcome, whether you're joining us in the evening or nighttime in the US or in the morning, as Dr. Weijian Shan is from Hong Kong or elsewhere in Asia. We're very happy to have you with us. I want this to be as interactive as possible. We're going to be conversing and we want you to be part of the conversation. So if you would like to submit a question, please go to the bottom of your screen and click on the Q&A icon and type it in. It will come to us and we will incorporate as many questions as possible throughout the conversation, rather than waiting till the end. I mean, that's our promise, that's our aspiration. I'm very pleased to introduce Dr. Shan, and we're so happy to have him back with us at Asia Society Southern California. About a little over a year ago, we had him for his first book, Out of the Gobi, My Story of China and America. And that was really about, it was a memoir of his life growing up in the Cultural Revolution and making it to America to work in American finance. And now the book Money Games that we're going to talk about tonight is the sequel in a sense, because that's Shan moving out of academia where he was teaching at Wharton, and then he decided he wanted to be in the action. He moved to JP Morgan and then to this private equity firm that was starting out called Newbridge Capital. And that really got him into the heart of deal making, and he came out to Asia, went out to Asia. And so the book, Money Games, it's a fascinating story that is told in such great detail with such energy of these negotiations and the back and forth. And it's not just a story about a deal, it's a story about a very important moment in time, the Asian financial crisis, and the efforts to reform economies, in this case, Korea. This was not just the sale of a bank, this was a very important milestone in Korea's renewal from the crisis and its opening to foreign investors. And you know, what's interesting is that this saga of Korea First Bank has been chronicled in a number of other accounts. That's how important it was, including one by one of the chief negotiators who was sitting on the other side of the table from Shan. But this is the first really comprehensive account of it from an insider who was really the architect of the deal and there from the beginning of the idea through Newbridge Capital's successful exit and very profitable exit from the deal. So now today, Shan is the group chairman and CEO of PAG, which is one of the largest private equity groups, invests in private equity, it's alternative investment, real estate, and others in Asia. And Shan, welcome. I'd like to set the scene for you to start. It was about a year after the IMF had given Korea $58 billion to get out of its crisis and the financial crisis. And part of that was to sell off state assets, in this case banks, and reform the banking sector. And so one day I think it was in New York, maybe San Francisco, and you get reports that Korea wants to sell both Korea First Bank and Seoul Bank. And you quote, what you said out loud, according to your book, is, who would want to buy a failed bank in a failed economy in the middle of the worst economic crisis the country has ever experienced? So, who did and why?
Thank you very much. Jonathan. And thank you for having me here. It's a great pleasure. Yes, it was extraordinary time in the middle of Asian financial crisis of 97, 98. If I can compare with the experiences in the United States, it was like buying Lehman Brothers in 2008, right? The bank failed. Just to put that particular event into context, Asian financial crisis actually started on July 2nd of that year with the collapse of the Thai currency baht. By the end of the year, Korean won dropped 65.9%. So 2/3 of its value was lost overnight. The stock market fell 49%. Earlier in October 23rd of that year, Hang Seng Index, the stock market index in Hong Kong, dropped 16% in one day, 16% in one day. So worse than any day in 2008 during the global financial crisis. By the end of the year, in Korea, the foreign exchange reserves with which the Korean government would use to pay its foreign debt dropped to $8.9 billion. My firm, PAG, today manages $40 billion. And a big country, the 20th largest country in the world, had only $8.9 billion in foreign exchange reserves by the end of 1997, I'm sorry. So the country was going to go into default in about a week or two. And that was when IMF, the World Bank, came in and provided the largest rescue package to any country to date in history, $58 billion. One condition of that package was for the country to sell two banks, not any assets, but just two banks, right, one of which used to be the largest in the country. The two banks were Korea First Bank and Seoul Bank. And the reason that the multilateral agencies required the government of Korea to sell those banks was because many, many banks, about 150 banks, failed in Korea prior to that time. And obviously, there was a serious problem with the banking system, which stopped functioning. And one major problem was the lack of credit culture. Loans were made on the basis of relationship or government policy without regard to the credit worthiness of the borrower. And that's how many banks with bad loan ratio as high as 30 or even 50% failed. So the World Bank and IMF thought the only way to bring credit culture into this country was through foreign investment. That's why the condition for the rescue package of $58 billion was to bring in foreign capital, foreign investor to buy these two banks. And that was the background of the story.
And why, when you thought out loud that it would be insane to buy a failing bank and a failing economy in an economic crisis, how did you get from there to the following 15-month saga?
Well, I always thought that to invest in a bank is to bet on the macroeconomy. When the macroeconomy booms, banks do very well. When the macroeconomy go down, banks are usually the first to suffer. Again, think about 2008, 2009. So many American banks failed, so many European banks failed. So I thought it was crazy to buy a bank which already failed, nationalized by the government in the middle of the worst economic and financial crisis that Korea ever experienced since after the Korean War. And of course, I was inexperienced in private equity. So my partner, Dan Carroll, who was sitting in the same car as I was reading this teaser sent over by Morgan Stanley, which represented the Korean government, and said to me, well, maybe we should send this to David Bonderman, the founder and chairman of TPG, with which Newbridge was affiliated. And he said maybe Bonderman would have some idea in this regard. The next day, Bonderman replied by email, very characteristic of him. He didn't know how to use, by fax. He didn't know how to use email at the time. So he sent the fax back. He said, the history of life shows that if the deal is structured right, this is as good as any time to buy a bank, and you can make a lot of money out of it. And so that's how we started the journey of trying to buy this major bank in Korea in the middle of a financial crisis.
And also for background, David Bonderman had done this successfully in the U.S. savings and loan crisis, right? This was something he knew firsthand that could be done.
Yes.
Is that right?
Before founding TPG, Bonderman was the CIO, Chief Investment Officer, for Bass Brothers, Robert Bass, I think. And there, or shortly after that, he engineered the acquisition of American Savings Bank in the middle of the savings and loan crisis in the United States in late 1980s. And he made a lot of money out of that particular deal, but pioneered the structure of good bank and bad bank to solve the problems of a failed bank. So we basically used that model with some adaptation for the Asian environment to acquire the bank.
So you had a good mentor.
He was the brain behind the transaction.
So that's why you got into the deal. Why did you write the book? What are you hoping to achieve in telling this story in the incredible detail that you go into?
Well, first of all, it's a very interesting story. It's a very complicated story. It's like no other story that has ever been told. Just think about the parties involved. In this particular transaction, there are multilateral agencies, IMF and the World Bank. Two governments were involved, one tangentially, one very deeply involved. Korea government, of course, and the US government, because Newbridge Capital, where I was a partner, was an American firm. And then, of course, taxpayers paid close attention to this particular transaction, since billions of dollars of taxpayers' money went into saving these two banks. The public looked at this transaction very closely. And then there were many, many advisors, there were investors, bank employees. So it was a very complex transaction. And I like to say, or I joked at the time, that this particular transaction became a national pastime for Korea because it was reported in newspaper every day. The Wall Street Journal, your paper, and your colleague reported it diligently at that time, and all the major international newspapers. But I think more importantly, it's a story about private equity. Private equity is much talked about, but very little understood. It's regarded as a mystery. Today, there are more private equity controlled companies in the United States than all the public companies combined. And that's how influential and powerful private equity is. So many people talk about private equity, and private equity, of course, plays a very important role in almost every major economy, especially in the crisis like today, lockdown-induced crisis today. But there's very little understanding of it. And there are some books about private equity, but typically written by reporters and typically about the deal-making part of the deal. For example, the book about RJR Nabisco's transaction by KKR. There's a book by the name of Barbarians at Gate, made into HBO movie, very well known. But that book was written only after 1 year of the deal making. And eventually the investors invested $3 billion in that transaction, if I remember correctly, borrowed $25 billion. So it was, almost a $30 billion transaction. After 15 years, investors lost money, probably to a tune of $750 million. But nobody talks about it because nobody wrote about what happened after the deal was put together. And similar stories were told by reporters. And this is the first time an insider is telling the story from the beginning to the end, from entry to exit, the full investment cycle. So I thought that for those who are interested in how private equity works, this will be a very interesting story for them to learn.
It is, and I want to talk about some of the bigger issues of private equity as we go along. The story, as you point out, is a very interesting story. It's got colorful characters. It will cause whiplash by the number of changes, and I don't know how many iterations of the proposal you guys went through, but I lost count, like after 20. I don't know. But
I did too. I don't even remember. Numerous.
It seemed like suddenly these new approaches were coming out of nowhere, and they were the solution. And in any case, but yeah, it's very rich in anecdotes and color. And so, yeah, I know you don't, as you told me before, you don't want to give away the whole story before people read the book. But I would, like you to talk about some of the sort of the highlights of that experience for you. Either in terms of the deal making or the cultural aspects of negotiating this. Because as you point out, private equity is still little understood. It was even less understood then, and it was totally new to the Korean government. You weren't a traditional bank after all. So what are your fondest or sourest memories of the process?
The negotiation process was very grueling. And I think one reason why it took so long and why the negotiation almost broke down numerous times was because there was very little understanding, mutual understanding between the two parties. The government side, the officials, all of whom were very dedicated, very hardworking, didn't know much about private equity, almost at all. They have never sold a nationalized bank in the past, and they were fighting for the best interests, or what they consider to be the best interests of their country and their people, their taxpayers, and therefore they were very, very cautious. They were afraid of giving the store away. And we represented our limited partners, our investors, who we call limited partners. In fact, many people, including people in this audience, have a stake in private equity. Our limited partners included, for example, the state pension funds in California and elsewhere, right? So we represented many pensioners and many small investors, whether or not they know it or not. So we wanted to make sure that if we bought a bank in the middle of economic crisis, we will not lose money. We will make money for our LPs, our investors. So there was very little trust between the two sides. We were afraid of losing money. They were afraid that we would make too much money. So how to bridge that gap was very important. And eventually, as I described in the book, I came up with a formula how to build that trust. And we spent more time trying to communicate with each other, trying to build that trust. And that was the most memorable part. Eventually, we put a deal together, which I consider to be good for both parties. It's very rare. Many people think of negotiations as a zero-sum game. I don't think so. Eventually, we created a structure that is beneficial for the government side as well as for our side. For example, I'll just pick one element of it to tell you. In the middle of the discussion, we were going to buy 51% of the bank. And the government was going to invest almost the same amount of money to own 49% of this bank after we recapitalized the bank. And then David Bonderman called me and said, Shan, let's offer 5% warrants to the other side. The other side didn't even ask for it. Warrants are options for the other side to buy more shares at the cost of our investments. So basically 5% more upside to the government side. And why did he do that? And I hesitated for a moment, and I accepted his suggestion and offered to the Korean government side because we wanted to show goodwill. We wanted to show that we want you to get better upside than we do. And that went a long way to build the bridge of trust between the two sides.
Right, and I think I also recall when you took another sort of unsolicited step in sort of showing the government your sort of profit model, like how you guys were going to calculate the returns before you got to that stage in the negotiations where you really had to. I mean, you in your telling, you bent over backwards to build trust, often to just see it turn on you and have things change at the last minute after the government had already let reporters know that the deal was imminent. I mean, that's what I found remarkable. There must have been 10 or 15 separate cases when reporters had been alerted by the government that it's going to happen tomorrow. And then the government would come back to you and change the terms, including at one point saying, we want control of the bank, even though the IMF had been quite clear. I mean, how did you process this? How did you keep your cool?
Well, I thought that the only way to build trust is to be somewhat transparent. Of course, in the negotiation, you couldn't be 100% transparent, but I thought that people would suspect that there were some things that you knew that they didn't, and therefore it was very difficult to make progress. So it's almost unheard of for anyone in the negotiation process to reveal his hands in the middle of a negotiation. That's exactly what we did. I thought if they were so concerned about us making too much money, we might as well show them our financial model, because we have to build a model to figure out what would happen to this bank in our hands, and we have to make some assumptions. We have to project how the assets will grow over time, how the capital will be deployed, how many people we would hire or retain on the payroll. And I thought if I show this model to them, then that would allay their fear that we were making too much money out of this deal. And that's what we did. They were very surprised that we were willing to do it, because it's like revealing your battle plan to the other side in the middle of a war, right? But that was a good step to build the trust between the two parties.
Now, in your book, there's some very interesting photos and as well as some cartoons that you included at the time to sort of let the reader know what the atmosphere was like. And I think if you want to talk about them, I think we can show them to the viewers, if you want to talk through them, because you thought that they were emblematic of the atmosphere.
Yes, indeed, because negotiation was on the verge of breaking down several times. And of course, this deal received so much attention from the public and the media, so it was being reported incessantly at the time. And there were some very interesting cartoons which reflected the atmosphere at that time. If we can put up, one of them is this one by Mail Business Weekly or something. So this girl sitting in the middle, with hot spots on her face, and she's using a fan, a Korean style fan, and the logo on the fan is Korea First Bank. It's the bank that we're talking about. And she's crying, right, in the middle of the village. On the left-hand side, and this woman with a baby on her back says, I heard that they spent $3 billion to give her cosmetic surgery. And the other woman says, well, I heard they want to spend another 3 trillion won, about $3 billion US, to improve her face. And then on the right-hand side, and that Western look gentleman represents Newbridge Capital, that is my firm, and the bubble over his head reads, she doesn't look anything like her photos. So the Korean press basically says, this bank is so broken, even after the government injected billions of dollars or trillions of Korean won into it, it just didn't look good enough for this foreign investor to be interested. And that was during the time when the negotiation was reported of having broken down, even though we never disengaged. So this is one of them. And there's another one, I think, quite interesting. If you can find.
I think it's going to come up in just a second.
Yes, this one.
There we go. Mm-hmm.
If you can put it up. Right. So again, there was a report that negotiation broke down, and that bridge, that drawbridge, represents Newbridge Capital, that's my firm, and the Western-looking gentleman up there was shouting, and then down on the pier, the gentleman was, in fact, the president of Korea, South Korea, Kim Dae-jung, and he's holding a bag of blood, transfusing into Korea First Bank, this wobbly girl. And then the man on the bridge says, I come here for a wedding, not a funeral, indicating that Newbridge was pulling away. So, these cartoons, and there are many of them, and I included a couple of them in my book, really give you some idea how much attention was paid to this transaction and what the feeling, the mood was in Korea at that time. In 1998, when Korea's foreign exchange reserves dropped to a level that it could last only about a week or two before Korea would default on foreign debt, the government encouraged Korean citizens to sell their jewelry, their gold, in order to replenish the foreign exchange reserves. So it was a very painful time in the history of Korea. And Korea was never open to foreign control of a bank. And now they felt that this condition was imposed onto them by international organizations such as IMF and the World Bank. So it was a painful decision that they made to bring in foreign capital and foreign control of bank, and they didn't know what it would bring to them, whether it was a good thing or bad thing. And I think most people doubted it was a good thing. When you went to Korea in 1998, it was very interesting. It was in the middle of crisis. IMF came in with the largest rescue package of $58 billion and saved Korean economy. And yet every elevator that you go into, there are two buttons, open and close. And open is supposed to be good, close is supposed to be bad. All the close buttons are labeled IMF, meaning it's just bad. So whenever you go into an elevator, you push on IMF. And that was very reflective of the mood at that time.
And
that's why this bank deal was so important.
Important and excruciating, because
Yes.
you know you're dealing with officials from different ministries and different task forces, and they have different pressures. But it was, you know, at the time then, with all the setbacks, back and forth, months, you know, day to day sometimes. You know, your partners at Newbridge Capital were also having doubts. I mean, there was a lot of consternation and a lot of questioning about moving forward. And I kept asking myself as I was reading it, why did you keep persevering? What was the mission that you were on? And also, did your family at some point say, look, you know, Dad, this is great you're doing this, but because you were commuting from Hong Kong, but please don't go back. This seems to be a lost cause. Were you getting pressure from people in your family or people you knew in Hong Kong who were just like, this is a fool's errand?
Yes, indeed. I still feel very guilty to my children and my wife that I was absent more often than not during that period of time. The negotiation lasted months and months on end. You know, there's a thinking within the investment community that you have to be able to cut losses. If something doesn't happen, you have to be able to walk away. You can't just get stuck. And some of my partners kept reminding me of that, but I just thought that if there was a thread of hope at all, you know, we should just persist in my life, as I described in my first book, Out of the Gobi. I persevered when I was a hard laborer in the Gobi Desert of China. And in comparison, this was nothing. At least we had enough to eat. Camped out in the hotel in Korea. And I thought that it was a very significant deal. If we could do the deal, it would do good to the country, bringing banking restructuring to the country, bringing credit culture to the country, bringing international best practices in banking to the country. And it would be very good for our investors as well. It would be a milestone transaction at that time. So we just persisted. And incidentally, your colleague at the Wall Street Journal, I know at that time you were in Indonesia, and banks were failing all over the place in Korea, in Japan, in Indonesia, and other countries at the time. One of your colleagues, Henny Sender, was based in Hong Kong. And she saw me on some weekends. She knew I was commuting to Seoul almost every week. And she joked with me. She said, "Shan, I will steal your passport so you couldn't travel to Korea. Why are you still hanging in there when there's no hope at all?" But eventually things turn around.
And so jumping to the end a little bit, you finally conclude the deal 15 months afterwards. Newbridge Capital comes in.
Oh, you're giving away the story. Well, I think how long it took us.
I won't give it away. Tell us. So the story is, the book is about the saga of the negotiations, but then it also discusses what Newbridge Capital, this private equity entity, does once you buy Korea First Bank, and how that story, I think, seeks to dispel some of the bias against private equity, which is, you know, highly leveraged, borrow people's money, buy something, strip it down, pay yourself, compensate the partners well, and then sell off the rest. That wasn't the plan, and that wasn't the experience of KFB. So I would say, in a nutshell, explain the key points of your ownership and how you turned it around.
Yes, I remember we eventually signed the definitive document to buy this bank after a grueling many months of negotiation, ups and downs, sometimes despair, sometimes hope. Eventually, we signed the transaction. And I called David Bonderman to tell him that we signed. And the only thing he said was, congratulations, but now the hard part starts. So all that work, all those sleepless nights, he didn't think hard enough, because what really matters is what you do with this investment, with this bank, after you have invested. Henry Kravis of KKR is very fond of saying, I hear him say this many times, that any idiot can invest in a company, can buy a company. It is what happens afterwards that really matters. That indeed is the case. I think there's misunderstanding in the market that private equity operates in such a way that it buys cheap and sells dear and make money on the difference, or it buys a company, strip the assets, pay themselves dividends, right, without regard to the health of the company, and that's how private equity makes money. I can't rule out some people do that, but that's not our experience. If you want to sustain a business in private equity, if you win the trust of your LPs, limited partners, to give money to you to manage, like the state pension funds, corporate pension funds, then you really have to show how you create value. And the way we created value was to take over control of the bank, install what we considered to be a world-class management team. And we built a risk management system so that we reduced the bad loan ratio to a minimum. This bank and many other Korean banks failed because of lack of risk management system, so that loans became bad loans. Borrowers were not able to pay back the loan because they were not qualified borrowers in the first place. So we installed a risk management system that eventually brought our bad loan ratio from more than 30% when this bank failed to less than 1% when we went into the operation after a couple of years. And we grew the bank 4 times during the time we owned it. Initially, the bank was overstaffed because by the time we took over, the assets of the bank became a skeleton of its former self. So many bad loans disappeared or taken over by the government. So it became a small bank, but our staff was still more or less the original size. And a decision had to be made whether to cut the payroll to fit into the asset size of the bank or what. And our CEO eventually, Robert Cohen, who became the CEO of the bank, made the right decision to grow the body into the clothes as opposed to cut the clothes to fit the body. So with redundant employees, we built a larger business and eventually became very profitable. We made more than $200 million in the first year on the invested capital of $1 billion. So more than 20% in the first year. And that's how we created value.
And, without going into all the other bullets your management dodged before the exit, after an investment, a combined investment, Newbridge and the government, of about $900 million, the bank was sold for about $3.3 or $3.4 billion. Is that right? 5 years after you purchased it?
Yes.
So
I have to confirm it.
I'm sorry?
I have to confirm it. Now you're asking, yes. But that's towards the end of the story.
Yeah, but not really, because there's another book to come, I understand. But anyway, so that leads to one of the audience questions that that this was the Korea First Bank was a very successful marriage. But could you talk about, not every deal is successful, and so this is a question from Brian Triger. He wants to know if you could describe one of the Asian funerals that Newbridge or PAG subsequently attended and what lessons you may have learned from that, of what you might have done differently in one of those particular deals.
It is very difficult to talk about failures, especially if the failures were done by your competitors. But you don't have to go very far than the United States to look at the failures around you during this particular recession, the lockdown-induced recession. A number of companies have failed, and many of them were owned or controlled by private equity firms. Toys R Us, I think, failed the last year or even earlier before the COVID crisis hit. And I think this year you saw retail giants, ranging from Macy's to Bloomingdale and all that, even J. Crew, which of course was owned by private equity firms, Neiman Marcus, all these firms failed in the crisis. And in 2008 and 2009, many of the private equity owned firms failed. And the reason for that, in fact, I looked very deeply into this issue. Private equity is supposed to outperform the public market. Private equity is supposed to provide outsized returns to limited partners or investors. But when you fail in your investments, obviously your investors lose a lot of money. And how that happened? And I think that if you look at the data of private equity, you would discover, in fact, many private equity deals make money by taking on leverage. So in boom years, leverage would, of course, juice up your return. But in the down year, leverage can kill you. When the company's cash flow dries up, like many companies did this year, then obviously the leverage becomes very, very dangerous. So leverage is double-edged sword. It can help you, it can also kill you. So many failures can be attributed to over-leverage by private equity firms. And data show that in America, typically the leverage ratio in acquisitions, the so-called leveraged buyouts, is much, much higher than Asia. And we invest mostly in Asia. We have some portfolio companies in the United States. And in Asia, it is exceedingly difficult to get leverage. Especially in China, it's almost impossible to get leverage. But even if leverage were as available in Asia as in the United States, I, as a very conservative investor, wouldn't want to take so much leverage, knowing that crisis is almost inevitable. Economic cycles are inevitable. So you have to be prepared for a rainy day at any time.
And a number of participants also would like your view on the Lone Star investment in Korea, which was also a bank investment, and what your opinion is and what the difference between your deal was and the Lone Star investment. And if you could, for the audience, quickly summarize what the Lone Star deal was about.
Okay. There are actually a number of Lone Star deals. Lone Star is a firm I highly respect, and they have done very good deals. Their first deal was actually in Japan. They acquired a bank, a city bank called Tokyo Sowa Bank, which they renamed as Tokyo Star Bank. And they made a lot of money out of that bank. And after 5 years, they sold it to another private equity firm, which invested about $1 billion, and it was total wipeout. So not every private equity firm makes money. Lone Star made a lot of money, and its successor investor lost a lot of money, almost tanked that particular private equity firm. Now, Lone Star started to look at Korea Exchange Bank after we acquired Korea First Bank. Our bank deal was different because it was a government-assisted bank deal, meaning that the government put money into that bank, and the government nationalized that bank, and then sold it to us. But Korea Exchange Bank was government-controlled, but it was still a functioning bank, and they were negotiating with the government to buy the control of that particular bank. Many things happened in that process. There were some problems with certain members of Lone Star team, which really got them into trouble, some legal trouble as well. But I think they made the best effort to turn around that particular bank. And eventually, I think that bank became very healthy, and Lone Star made a lot of money. Although I think over some issues, how the bank was sold by government officials, whether there were problems in that sale process, became very controversial, which really doesn't surprise me, because every bank-controlled asset, if sold, receives a lot of public scrutiny, and so you just have to go through that process.
And particularly in Korea, where the structure of the banks and the chaebol and the expectations of lending to the chaebols and the government, it was all very clubby at that time, and it wasn't structured according to just business principles. You write in your book about your deal, about Korea First Bank, only with hindsight could I fully appreciate the extent to which nationalistic sentiment influenced the government's attitude and approach to the deal. And you've discussed that just recently and showed and so far. But here we are. Let's jump forward till today. I mean, you learned lessons from that, and you've done deals in other countries, including China. But what about today? I mean, there's a surge in nationalism in Asia. It's not aided by the fact that there are trade disputes, not just with China, but with Korea and U.S., Korea, and Japan to some extent. So, how would your deal be doable today in today's environment, or how would you have to approach it differently, if any differently?
Probably not. It was an unusual time at the time. And today, for example, if you want to buy control of a bank, it's almost impossible. If you want to own more than 4% of a bank by a foreign investor, and that's probably the limit. At most, I don't think you can own more than 10% of the bank. And that is by banking regulation. But if the bank were distressed, then that rule could be relaxed, as happened in 98 and 99 during the crisis. In almost all markets, especially in the United States, banking is under such tight regulation that foreign control of a bank is almost impossible. You won't be able to get approval from the Fed. I think that foreign investment, especially the right kind, that comes with technology, expertise, and skills, is good for the recipient country. We had some experience also taking over control of a bank in China. And at the time, there was great doubt whether or not China should allow American investor to take over control of a bank. And eventually, I think rationality prevailed. We were able to do so. But the difference between Korea and China at that time was that Korea was almost forced to take foreign capital. It was a condition imposed upon them by world organizations. And China had plenty of capital. What they didn't have was a credit culture, international best practice in managing banks, and how to really run a commercial bank. So all the major banks in China by 2002 were laden with bad loans, as high as 40% of total assets. So China made a conscious decision to bring in foreign capital to help restructure and reform their banks, even though they didn't need the capital. They just needed the expertise. I think capital and expertise really would help the reform of a banking system. For example, in 2008 and 2009, the crisis, what you would call a global financial crisis, even though it didn't really spread to Asia, and I'll explain why, started with the collapse of Lehman Brothers, Bear Stearns, AIG, all these large American financial institutions. Everybody was in trouble. Goldman had to raise capital from Warren Buffett. Bank of America had to do so as well. European banks failed left and right and center. So it was a huge crisis in 2008 and 2009. But the reason I object to the term global financial crisis is because none of that happened in Asia. None of the banks failed in Asia in 2008 and 2009. Why? Because they learned a good lesson from the 98-99 Asian financial crisis. All the banks were well managed, well capitalized, with very strong risk management system, so they were all spared. And this time around, in this lockdown-induced recession, American economy, GDP dropped 9% year over year in the second quarter, worse than 2008, 2009. Did any bank fail in the United States? No, they didn't fail. None of them has failed. The reason is after 2008 and 2009, all the banks learned a lesson, regulators learned a lesson, and now the banks are well capitalized and with very strong compliance and risk management culture. So now the banks are resilient. Imagine if banks failed today as they did in 2008, in the middle of this virus-induced recession, how much worse a situation we would be in, right? So foreign investment brought in experience, skills, and a culture that really helped the country. And I believe it used to be the case, it is still the case.
And which brings us to today. Banking, obviously the financial sector is something unique. So given that was the subject of your book, but today with the pandemic and a number of companies and economies under duress, a number of our participants tonight would like to know what lessons you learned from the Korea First Bank experience that you can apply to today's condition, and where do you see the opportunities for private equity in the current economic predicament environment in Asia? Which markets, which sectors?
The reason that Korea went into so much trouble, as other countries, Indonesia, a country you're familiar with, was because there was too much debt in the system. The societal debt was at a very high level. In 1998, the average debt to equity ratio for all the corporates in the United States was about 78%. Debt to equity ratio, 78%. In Korea, for the large tables or conglomerates, the average was 5 times. And that's how levered Korean banks were. So some banks, some borrowers had even higher debt equity ratio. And so if you have so much debt in the system, of course, a crisis when it comes becomes very, very severe. And I think the lessons learned is to make sure that you know that economies go through cycles. The down cycle is inevitable. So you have to be prepared for a down cycle, and therefore having enough cash, working capital is very important. The same is true for corporates as for banks.
And in today, given the COVID pandemic, where are you seeing the most vulnerability in Asia? Which markets, and therefore, does that create a greater opportunity for the kind of expertise, whether it's financial or management expertise, for private equity firms like PAG? Where are you focusing?
Yes. You would find that through this crisis, some of the sectors are probably permanently impaired. If you look at travel, if you look at, maybe airline business, if you look at cruise business, some of the businesses are maybe long-term impaired. So even though they're down so much, it'll be very difficult for you to make an investment because you don't know if they will ever come back. But the crisis also revealed some very good opportunities. For example, e-commerce is doing extremely well. We are a large shareholder of Tencent Music Entertainment, which is the largest digital music streaming business in China. We have 800 million unique monthly users. The company is listed on, I think, New York Stock Exchange, or in any case, in the United States. Revenue, EBITDA, cash have all been up this year. I don't have any inside information. It's all based on the public information. So even though the economy has suffered from the lockdowns, but this business is doing extremely well. We own a business, the largest dairy milk, cow milk business in China called Yuran Dairy. And our EBITDA this year went up 40%. And I scratched my head. I didn't understand why that was the case, even in the middle of a lockdown. And I was told, or I surmised eventually, that people in China finally discovered that the milk that does the body good, as you hear in advertisements in America all the time. So people started to consume milk in large quantities. So you would find some interesting opportunities revealing themselves in a crisis. And this is a good time to buy because valuation is much more depressed than in the past. You just have to be very careful. But by and large, we think that businesses which cater to private consumption in Asia are the best bets, and not banks anymore.
Not banks. Well, you got out of that one, so congratulations. And I might want to point out that I asked you when we were preparing for this whether the Korea First Bank negotiations had been the most excruciating, longest ones for you, and you said actually no, and a longer one is going to be the subject of your next book. I'll leave it at that, but since you don't want me to give too much away. Unfortunately, I wish we could keep talking, but our hour is almost up. I just want to thank you again for your storytelling, and I want to let the audience know that this is a book that is, if you're very into private equity, you'll learn something. If you're interested in Korea and Asia, you'll learn a lot. If you have no financial knowledge, you'll learn a lot because Shan writes in a way he demystifies these very complex banking and negotiating issues in layman's terms and very easy to understand analogies. And if you think that bank deals are boring, I'll just tell you that this one involves wiretaps, code names, and as Shan mentioned, sort of old technology like fax machines, and fax machines that can run out of paper just when a very important bid is coming in. So it's a rip-roaring tale, and I would just like to thank you again for speaking, and I'm going to turn it back to Charlie Coker. Thank you very much.
Thank you so very much, Jonathan.
Well, thank you, Jonathan, and thank you, Dr. Shan, for an amazing conversation this evening. We'd very much like to let people know that the book will be available. I think it's coming out either today or tomorrow, and it can be either purchased or pre-ordered on Amazon.com.
It's released today.
Released today. Well, thank you for that. So it's available on Amazon today. When I had put it was a pre-order the other day. So, and as Jonathan said, it's a fascinating story and a really a scintillating story. And we'd also like to thank our partners who've helped promote this program. You'll be able to see them on the slide that'll be coming up shortly. We also like to encourage people to join as a member of Asia Society Southern California, or to donate to be able to support programs like this, which we bring to you for free. And that slide will be coming up shortly as well. So we'd also like to let you know that our next program, which we'll be talking about the world in transition, will be coming up on October 21st at 5 o'clock Pacific time. And we'll be featuring a conversation with Ambassadors John Emerson and Nina Hachigian. And Jonathan will be returning as the moderator, and hope that you will be able to join us for that as well. So thank you again for joining, and have a good evening.